This is a weaker than expected report, but look what's happened to the markets as Edward was speaking. As he's giving us this weaker than expected jobs report for the month of September, stocks going up. Bad news, good news, because investors are viewing this as less likely that the Federal Reserve overdoes it on interest rate increases. Kevin, your thoughts?
Well, my thoughts are Bryan Adams' song Summer of '69 is going to be going through the roof because that's what the jobless rate number is at. July 1969, 3.7%. It's just showing how strong this economy is. Now, the 2.8% on the wage growth was in consensus, and because we didn't get a spike, because it was lower than last month's at 2.9, it's showing that inflation is sort of tapered right here, and we're not getting out of control. So that could give the Fed reason to pause. Not that they're going to do it, but it could give them reason to pause.
That's what the investment community is looking at. Dow Industrials all of a sudden now up 50 points. We were negative going into this number. Joni Courtney, interesting to note that Hurricane Florence was an issue here. That's one of the reasons that we're seeing job growth slow sharply in the month of September, hurricane season.
Yeah, but you know what, Maria? I really think there's more to it than just the hurricane, because this is really basic supply and demand. There is a very strong demand for jobs. We have 6.9 million open jobs. I bet that number is going to increase the next time the JOLTS report comes out. So the demand is there. I think there really is still a challenge with the skills gap. You know, we talk about where these jobs are, and so skills and experience are very important, but the other piece is labor participation. We are still at 62.7% at labor participation. We don't have enough people in the labor market actually participating in the workforce. And that is something that we need to get the message out there, because there are jobs, there are opportunities, and people can really get out there and have a great earnings and great career, better chance to earn, new skills and development. A lot of employers are investing in education and training. I know we're doing that at EmployBridge, but it is a very strong job market. So that's where the disconnect is for me, is labor participation and the skills gap.
Yeah, Morgan Ortagus, we had the CEO of Career Builder on earlier, and she identified where the fastest growing occupations are in the next 5 years. Nurses, number one, software developers, number two, teachers, accountants, and marketing professionals among the fastest growing occupations with higher wages for the next 5 years.
Yeah, I think the bottom line is this report is a political winner for the administration. And your last guest, she was absolutely right about the skills gap. Going into the midterms and even into 2020, what this administration and whoever's in leadership should be emphasizing, Maria, is how we can get more people skilled and in these jobs. The trade deals, as your other guest pointed out earlier, are going to drive more manufacturing, more blue-collar jobs where there is high demand. So politicians should be focusing on how can we help get American workers skilled for this incredibly illustrious job.
I find this market reaction really puzzling. First, markets rallied. I get that, giving you an indication that the Federal Reserve may not necessarily rush to raise interest rates all that much, but things are mixed. Maybe things are just settling and people are digesting this number. John Hilsenrath, your thoughts on the number and the reaction?
Well, I think I understand what's going on with the market. So, I mean, the headline payroll number was pretty soft, but, I think a lot of that has to do with the hurricanes and distortion, so I wouldn't get too worked up about that. I think what the market is coming to grips with, that with the unemployment rate falling now 3.7%, lowest level since 1969, the Federal Reserve is going to continue to raise interest rates as it has been planning to do. The market didn't believe that. They were pricing in very low probabilities of continued Fed rate increases. Now investors are coming to grips with continued Fed rate increases, and that's causing a big increase in the bond yields and sell-off in the stock market.
All right, so same story as yesterday, Charles. You got a market that is mixed right now. Brian Brenberg, your thoughts on this number, real quick.
I think it's the wage number here, 2.8%, didn't scare the market. They didn't want to see a big number. They didn't see it. That was the initial jump. Now they're trying to figure out what's next, because it's not a great overall number, but they were happy about wages not being over 3%. That was the risk from the market standpoint. We didn't get it here.
Charles.
Yeah, I mean, we have revisions to July and August, 87,000. So who knows what this might be, particularly when you add in the hurricane stuff. So the top line number is not as important. The 3.7% rate, if it scares the Fed, and people are still leaving the job market, then I think that would be a mistake. In other words, I'd love to see this number going down as people were coming back into the labor force. The highlight, once again, goods producing jobs. We're talking about the heartland. We're talking about these states that President Trump goes to visit on a weekly basis. Mining 6,000, construction 23,000, manufacturing 18,000. This week alone, what did we hear? Hire of Japan. They're going to expand their Kentucky plant. 400 new jobs. It's spending $500 million. What do we hear this week? Mercedes and Nissan, because of the new NAFTA deal, they're going to build more in America. They're going to start to expand. These kind of jobs are remarkable. This is what the jobs that Main Street needs.
And Charles, continued record low rates on Black and Hispanic unemployment. Something else, the job market, it's not just in tech, it's also construction jobs still have room to grow. And so this is where labor unions can again help their skilled workers. So not just tech, construction as well.
The bad number that came out of this is that the U6, which is considered the underemployment rate, actually went up from 7.4 to 7.5. That includes people that are working part-time that want a full-time job. So that's the only bad number that I'm so far seeing. Otherwise, the narrative is consistent. But job numbers can be choppy, but this is a number that people should look at.
I wonder how much that has to do with the hurricane effects, though, and people falling out of one category into another.
Yeah,
that could be
retail and leisure were down.
Yeah.
Construction up, services up. So, I mean, when you see retail and leisure down, you could totally point to the hurricane as that. Lisa Erickson, your thoughts on where things go from here?
Yeah, I think this is a really nice number. Again, while there was a few surprises to the downside on the non-farm payrolls and then more even on the inflation wage gain, really, if you extend the outlook out to the end of the year, what you're seeing is a very supportive picture. So we think this is very positive. I think for the U.S. equity outlook through the end of the year, it's supportive of economy that continues to grow nicely, that translating into generally continuing gains in the labor market without excessive inflation that's really staying pretty moderate.